An effective trading process cannot operate in isolation.
Communicating and interacting with the dealing desk is absolutely key to making sure that we continue to get the best client outcomes.
Understanding each one of the stages, understanding the decisions that are made at each stage and the impact those decisions have, is critically important to understand how your role fits into the process and will also make you better at the role that you perform.
In today's volatile markets, cooperation and collaboration are more important than ever. But in such a complex industry, it can be hard to see the wood for the trees. With each section working in silos, the trade life cycle can sometimes seem to be made up of numerous cogs working on their own, with little thought for the wider process. But nothing happens in isolation. A decision made by a portfolio manager will have ramifications all the way down to execution, while a post-trade analysis can feed all the way back up to the PM. In partnership with the London Stock Exchange Group, we have created a detailed audiovisual journey, joining all the dots along the way to provide a holistic overview. Welcome to the life cycle of a trade.
I'm Nicola Morgan-Brownsell and I'm a fund manager at Legal & General Investment Management. I manage a £10 billion range of funds for some of the firm's key strategic clients. My role is working with analysts and strategists to originate ideas to go into the fund. So there are two primary ways that we can come up with an idea for a trade, and that can be derived from a pool of analysts and strategists who are focusing on specific sectors or regions or maybe even styles, and they are looking for best-in-class ideas. And then it can also be coming from a portfolio construction perspective. Once we've decided on the name that we want to trade, we then need to think about how we'll size it, but also how and when we will trade this. One of the things that does feature in our initial analysis is overall liquidity. You know, if there are a lot of funds that want to be buying this, is there enough liquidity in the name to be able to do so? And so a really important part of that initial conversation happens with the dealing desk, because they are the ones who have their finger on the pulse about this information. They'll be able to give us a much clearer idea if what we're aiming to do is actually possible. So once we've decided on the stock we want to buy and the size that it will be in the portfolio, and then it's a case of really closely interacting with the dealing desk, including our head of trading, Ed Wicks, because at this point our role hasn't ended. We still want to make sure that we get the best execution for our clients, because that is wrapped up in our fiduciary duty as fund managers. We then put it into the investment side of the dealing system, where pre-trade compliance will be run, and then we press a button and whoosh, it's gone off to the dealing desk. Throughout the idea generation and portfolio construction phase, input from the dealing desk is absolutely crucial. It's only through this that we'll know if our idea and the size that we want to trade it in is actually feasible.
Ed Wicks, I'm Global Head of Trading at Legal & General Investment Management. So my role at Legal & General Investment Management consists of executing all asset classes. Fundamentally, an important part of my role is to ensure best execution for our funds and clients. So the relationship between fund manager and trader is absolutely paramount. If we get that right, we have the best chance of delivering the best outcomes for our clients. The way we go about it at Legal & General is pretty straightforward. We interact very formally across morning meetings. That covers all asset classes and all geographies. And then of course there's the ad hoc interactions, and physically we're located as traders in the middle of the trading floor, and all the investors sit around us. And that makes for very seamless communication between portfolio manager and trader, and we feel eradicates as much friction as possible and leads to really good outcomes. Once Nicola sends the order to the trading desk, there's a number of ways we could deal with it. Now, it could be that all the instructions on the order are very, very simple, and it's a case of just selecting an algorithm and transacting it electronically. That could be one outcome. The other way it could go could be much more of a high-touch route. And that could be either a small cap security or a more illiquid situation whereby we need to interact a lot more with different venues and potentially different brokers in order to source liquidity. When we think about analytics on the desk, we have effectively two ways of consuming analytics. We work with a number of third-party TCA providers who give us a good deal of pre-trade estimates as well as post-trade cost analysis. And on top of that, we also have our internal trading research team that provides us with a good deal of information and data points as well. So market data and analytics are super important for the trading desk.
So I'm Alexandre Ardouin, Head of Equity at LSEG. So we do provide all sorts of products. Of course, we have a workflow solution, a brand new product called Workspace, which is now very light, very modern, very easy to find information. Of course, we have market data in that product, meaning that you have stock prices from all exchanges. But beyond prices and market data, you will also find lots of news. So market data and market monitoring is really, really important because you need, especially if you're a day trader, you really need very accurate price information to make your decision. And by very accurate price, you need to know what the market is doing at a given point of time before trading, because you really want to achieve the best execution. You need to find, for instance, we have tools to compare the different venues. So you can execute via brokers or you can execute on a trading platform. So we have tools like intraday market share. Intraday volume analytics also is very important. Where is the price compared to volume? So these are part of the very, very successful tools that users are using from us. And again, it's very important because you need to have very, very accurate data. So that also means you need to have connections to the right data providers. So from getting the news, then analysis on top of the news, then you are going to really to start at the execution data, the liquidity and the prices. So you would typically try to find the best execution venue to execute your trade. So you would compare what has the stock being traded over the day, intraday. You will also check what is the volume at price, what is the VWAP to ensure you find the best price on the base vendor. Once you have decided that, once you have found the relevant information, you will start executing that trade, which means you need to find you go either via a broker, a brokerage, or you do it yourself via an e-trading platform. So the step would be finding the news as events, doing your analysis, checking the ratios, finding the liquidity figures, the execution venues like VWAP, volume analytics, and then execution. You have to be able to trade in a click. So you see that a share that is moving, you click and trade in a few seconds. So that's really everything people would have on their screen. So you very often see 6 monitors with screens and market data everywhere, charts, news, alerts popping up, but it helps, traders, asset managers, hedge funds, buy side, sell side, to find the relevant information. Of course, AI, machine learning is very important. So we are adding some tools in that space. We are working on open directory initiatives that will allow users to connect to all our clients, to connect using Microsoft Teams and then share files or share messages in an automated way. So that's also very important. And the last thing I would like to mention is interoperability, which is also linked to ease of use. You would have lots of different applications that are not talking to each other. We have done a partnership with OpenFin, so Workspace is fully integrated into the OpenFin environment, which means that our Workspace ecosystem of apps can talk to other apps. So the trust element is really, really important because you can find news everywhere, but you have to find news and prices and market data that you can trust before making your trade.
A really important part to understand as a trader is the urgency that a portfolio manager has associated with any given order. If an order is really urgent, the fund manager has something they want to transact very, very quickly, in all likelihood, we may employ high-touch execution channels. That could be either electronic or it could be picking up the phone, speaking to brokers and other counterparties, both traditional and alternative liquidity providers, in order to find natural liquidity or in order to risk transfer that order. On the other hand, if we are faced with a basket of orders or a portfolio, let's say it's a cash flow, for example, with very low liquidity demand, then it would be much more normal for us to employ an algorithm as an execution channel. A very high percentage of our equity trading is actually transacted via algorithms globally. You might think that a trader's involvement ends once a trade is matched and booked with the back office. However, the reality is we stay involved a lot longer after that. An effective trading process cannot operate in isolation. We have to understand the other actors that are involved in a trade, from portfolio management all the way through to operations, data provision, and the sell side, of course.
My name's Nikki Brambleby. I'm a Global Liquidity Manager at Berenberg. When a client sends an order, it arrives on our desk, it's already in a predetermined strategy, so the client has a view on how they want to trade it. We'd then look at the trade, particularly look at the size, the notional, what's going on in the market that day, and if we felt that there was a slightly different way to trade it, we'd probably go onto the client and suggest a few tweaks. There's quite a few different types of algo that clients can specifically select. They range from volume weighted, time weighted, particularly liquidity seeking are very popular in order to grab that block if it's out there, if you can find it. I think the use of algos has increased significantly since I've been in the market. The main reason is clients feel they've got a real hold on what they're doing and they're deciding how and when and what strategy they use to basically affect best execution across the board. Market dynamics are what makes our job quite difficult because they create a lot of liquidity fragmentation. Fragmentation influences implicit costs, which is how many clients decide which broker to route to. It's imperative to stay ahead of our new venues, dynamics and shifts in market regime, and basically to ensure that the algos are behaving correctly and in line with the client's expectations.
So my name is Pip Franson-Walters. I'm the head of product for Prime Services in EMEA at Barclays. What is the role of the executing broker and where does it sit in the trade lifecycle? So earlier you've heard about how you might come to the decision as to what you want to do. You're then going to come to the part of the trade lifecycle where we talk about how do you actually go about doing it. So the role of the executing broker is to offer clients access to liquidity, access to markets, also to give them access to technologies and trading algorithms. Where it sits in the life cycle is a client will have already decided what they want to do. They already know the trade, they've already gone through the trade ideas. They come to the executing broker and discuss with them how to execute that trade. Some clients may have already identified a liquidity provider. In that instance, they may not use an executing broker. They may go directly through a third-party venue tool, but otherwise they would come to the executing broker for execution services. Why can't a trader just hit a button and execute a trade? Well, some of our clients do actually have order management and execution management systems. They do have execution algos. Again, it comes back to, do they have that market access? Do they have access to different venues, different forms of liquidity? So how might you choose your executing broker? You'll be considering things like their execution capabilities. So what is the portfolio of offering they can give you? The other thing you might be considering is price. So when you're looking at what do you as the client, what is your execution intent around your trade? Therefore, what benchmark are you looking to hit? What is your price? All of those types of things. You'll also be thinking about overall technology and platform. So I've already referred to execution algos, but you'll be looking at your executing brokers sort of platform latency, platform resilience, platform scalability, those types of things. You'll also be considering best execution. So this is not just about how they go about doing the trades, but how do they actually perform? What grade do they get on their homework effectively? When we onboard a client, we go through the usual KYC and compliance checks, but we also discuss with them their execution needs. So what type of execution are they looking for? From the high touch to the low touch. That dictates what they're actually set up for, what channels that we create for them. As a result of that, that then dictates when they want to execute an order, how do they interact with their executing broker. If it's your high-touch single stock, they'll be calling up their executing broker directly, they'll be having a conversation with them, they'll be discussing the type of trade the client wants to do, whether they want to do it on risk or not, etc. The other end of the spectrum, the client is just sending orders in to the trading algorithms. Those are coming in automatically, and the algorithm is using its smart router to route those out to various different venues. It understands the liquidity across those venues, and it looks to execute across a wide portfolio. It's all about appropriateness for the client. So they'll be set up, as I said, for either the high touch, low touch, or something in between. Then when it comes to actually trading on the day, the client will send in those orders, and depending on the channel that they're using, those will then flow down to the different venues. Once you've actually sent the orders through to the executing broker alongside the client then has responsibilities around reporting the trade details back to their counterparty. They also need to monitor the trade for settlement. They also need to make sure that if a trade is failing, that the executing broker works with the counterparty to ensure that failed trade is resolved. Also need to send trade information to the street side, so to the clearing houses or to the other brokers if you're like a prime broker, etc. And then finally, we might also have regulatory, or we will have regulatory reporting requirements. So the executing broker also has to report to the regulator. In the trade life cycle, at what point does the executing broker's role finish in the life cycle of the trade? So if we recap the trade steps, we've already covered the execution part, we've covered the settlement component, we've covered reporting to the street side, reporting to the regulator, handling with failed trades, we've sent confirmation back to the client, then we've kind of performed our piece. We will produce post-trade analytics or sort of cost analysis, and that comes back to the point of marking the homework. That gives the client that line of sight to how well did we do the job? Did you hit them on those benchmarks? Part of the executing broker's role is to ensure the settlement of the trade. Once the trade is settled, the trade is settled, the trade is done. As it relates to the trade life cycle, prior to clearing and settlement, the executing broker or the execution process is the final stage.
Hi, I'm Jessica Morrison. My role is the Head of Market Structure and Quantitative Analytics for the London Stock Exchange, and that's within the Capital Markets division. So my role within Capital Markets is to really help bring additional transparency to the market about the way all the different venues operate, so that people can interact with them and get the outcomes that they're looking for when it comes to trade execution. So what is market structure? Market structure is all about how you trade rather than what you trade. So once the buy side has selected the stocks they want to trade, and once the sell side broker has decided the best way to trade that order, we're really thinking about everything that impacts how you can interact with the market. So on the macro side, what impacts how you can trade, so that's regulation, the kind of rules of the road, that's technology, physically how you can interact with the order books, and that's explicit costs, be they government fees or taxes, things like stamp tax versus exchange fees. And then really what we do is join the dots with what it does to the impact on liquidity. And this is where it gets very quantitative, and that's where you get into micro market structure. So it's really thinking about if a rule were to change, if a fee were to change, if technology were to change, what does that do to volumes? What does that do to intraday curves? What does that do to growth? What does that do to costs? So where on the macro side you've got the explicit costs, on the micro side you've got implicit costs, which really ties back into pre-trade analytics, into post-trade TCA, and really understanding the quality of execution. When a sell-side broker is coming to execute a trade, they're obviously going to need to stay up to date with all the different venue offerings that are available. We've seen a lot of evolution since the beginning of MiFID. But now we've got to the point where you've got lit continuous, you've got lit auctions, you've got dark venues that are operated by MTFs, you've got now conditional venues as well. So all of these different types of trading book will give a different kind of execution experience and will be better matched to different styles of trading. So for example, if you're looking to trade in size, if you're looking to trade a large block of stock, then potentially going to want to use something like a conditional venue where you can limit the information leakage of a trade. as opposed to someone who wants to trade over the course of the day, can afford to be a bit more passive and wait for opportunities to come. They may be more likely to choose a continuous venue. It's really important for both the buy side and the sell side to be able to do appropriate venue level analytics. Depending on the market participant mix that you have within a venue, venues will have different styles of liquidity, different quality of liquidity, different quantity volumes of liquidity. So really our job as the exchange, as the operator of a number of these platforms, is to make sure that we have both the right kind of innovative, competitive venue offerings for the sell side to be able to choose from. And then within those, making sure that we're providing enough information, enough transparency, whether it's through market data services or just by making sure that people understand the details of how our systems operate, that they're able to interact with them to the kind of optimal level. You know, I think we're really uniquely positioned as that central hub within the equity trading landscape to be able to listen to feedback from all sides of the market participants, whether it's the buy side, whether it's the sell side, whether it's post-trade, whether it's thinking about operationally how a business can be run, whether it's thinking about the technology interfaces that people need to best able to connect with us. You know, stability, operational resilience, there's many things we need to think about to make sure that we are there, that we're there for market participants when they need us, but also very importantly how we make sure that we're positioning ourselves for the future and that future can focus on growth.